Imagine walking into a bank with $500. You walk up to the counter, take a number, and wait. Now imagine walking into that exact same bank with $10 million. You don't take a number. Someone is waiting for you. The office is private. The conversation is different. And instead of asking you what you need, they start asking what they can do for you. That's because banks don't treat every dollar equally. The more money you control, the more valuable your relationship becomes. And somewhere between $0 and $25 million, banking changes dramatically. So today, we're climbing the wealth ladder to find out exactly what happens at every level. From being a completely ordinary customer to becoming one of the bank's most valuable clients. Let's start at the bottom. You have $500 in your account. To you, that money matters. But to a bank, it's almost irrelevant. You're using the same basic checking account as millions of other customers. The same debit card, the same standard savings account, the same fees, and usually the same interest rates. The bank isn't particularly interested in the $500 sitting in your account. It's interested in what you might become. Because your future income could be worth far more than your current balance. Your first job, your first credit card, your first car loan, your first mortgage. The bank isn't really banking your $500, it's banking your future. And that's an important distinction. At this level, you have almost no negotiating power. You're a customer, not a relationship. Now you've built a little more financial stability. Maybe you've got $5,000 sitting in savings. You have a credit card. You've started building a credit history. And the bank begins learning something about you. Are you paying your bills? Are you keeping money in your account? Are you borrowing? Are you depositing your paycheck? You're still nowhere near wealthy, but now you're becoming profitable. And this is how banks actually make money from ordinary customers. They don't necessarily make much from the money sitting in your checking account. They make money from the financial relationship surrounding it. Your mortgage, your credit card, your personal loan, your investments, your fees, your future borrowing. And this is where something interesting begins to happen. The bank isn't just holding your money anymore, it's starting to build a relationship around it. But there's a huge difference between having $10,000 and having $100,000. And that's where the economics start changing. At $10,000, your money is still relatively small. But at $50,000? Now the relationship starts becoming more valuable. You've potentially got meaningful savings, investments, retirement accounts, maybe a growing business, and possibly a future home purchase. Suddenly, the bank can see something it couldn't see before. You have assets, but more importantly, you have potential. Banks don't just look at what you have today. They care about what you might borrow, invest, and earn over the next 10, 20, or 30 years. And that's why your first $100,000 can be more important than simply having $100,000. It changes your financial options. You may qualify for better products. You have more leverage when shopping around. You can start separating your everyday banking from your investing. And you're building the financial history that can eventually lead to something much bigger, borrowing power. Because once you have meaningful assets and income, the bank may actually want to lend you money. And that's when the relationship gets really interesting. This is where your relationship with a bank can start to feel different. Imagine you have $200,000 in investments, a strong income, a healthy cash reserve, and you're looking to buy a home. Now you're not just another person opening a checking account. You're potentially bringing the bank a mortgage, investment assets, savings, credit products, and years of future financial activity. That's valuable. And when you're valuable, competition starts working in your favor. You can compare lenders, negotiate, shop around, ask for better terms, and depending on the institution and your overall financial profile, you may start getting more personalized service. But here's the important part. Having $200,000 doesn't automatically unlock some secret VIP banking menu. Banks care about the entire relationship. Your income, your assets, your borrowing, your creditworthiness, and how profitable you are as a customer. That's why two people with the same net worth can be treated completely differently. And that becomes even more obvious around the next level. 500 US $1 of $1 million. What can we do for you? Now you're approaching a level where wealth management and affluent banking services become increasingly relevant. And this is where the conversation can begin to shift. Instead of, here are our standard products, it can become, what are you trying to accomplish? Depending on the bank, you may have access to relationship managers, more tailored lending, investment services, more sophisticated financial products, and potentially preferential pricing or terms based on your relationship. But here's the surprising part. The bank isn't necessarily impressed by your $1 million. It's interested in what that $1 million represents. If it's sitting entirely in cash, that's one relationship. If it's spread across investments, property, a business, retirement accounts, and borrowing, that's a completely different relationship. Because the bank can potentially serve more parts of your financial life. And once you move beyond roughly $1 million in investable assets, another door can start opening. Private banking. This is where banking starts feeling like a different industry. At this level, certain institutions may offer private banking or wealth management services designed specifically for high net worth clients. You might have a dedicated relationship manager. Your lending can become more sophisticated. Instead of simply qualifying for a standard mortgage, you might have conversations about borrowing against investment portfolios or structuring credit around your broader assets. And here's where the wealthy gain something most ordinary customers don't have: flexibility. Imagine you own $3 million worth of investments. You need $500,000. The average person might think, I need to sell some investments. A wealthy investor might have another option: borrow against the assets instead. That doesn't automatically make borrowing better. Debt still costs money, markets still fall, and lending against investments carries real risks. But it illustrates the fundamental change. At lower wealth levels, you're mostly asking, what can I afford? At higher wealth levels, the question becomes, how can I structure this? And that distinction becomes enormous as the numbers get bigger. Now we're entering territory where the relationship can become significantly more complex. You might have multiple properties, business interests, large investment portfolios, private investments, trusts, different tax considerations, and potentially substantial borrowing. At this point, your financial life doesn't fit neatly inside a checking account, and the bank isn't simply trying to sell you a credit card. It may be trying to manage an entire relationship. Private banking, wealth management, specialized lending, asset-backed credit, estate and legacy planning. Depending on the institution and your circumstances, you may also encounter services aimed at very wealthy families, sometimes approaching the type of coordination associated with a family office. And here's the strange thing about getting richer. Your money can actually become more complicated to manage. At $10,000, you need to figure out how to grow it. At $10 million, you need to figure out how to coordinate it. And that leads us to the top of our ladder. At $25 million, you're no longer asking, where should I put my money? You're asking something much bigger. How do I structure it? Because at this level, protecting wealth can become just as important as growing it. You might have businesses, real estate, public stocks, private investments, cash, debt, multiple generations depending on your family situation. And suddenly, a 1% mistake isn't a minor inconvenience. It's $250,000. A bad investment decision? Potentially millions? A poorly structured estate? Potentially enormous consequences for the next generation. So the focus starts moving away from simply maximizing returns and toward risk management, tax efficiency, estate planning, asset protection, and legacy. The goal isn't just to become richer, it's to make sure the wealth survives. And that's the biggest misconception about wealth. People assume that wealthy investors simply have more of what everyone else has: more stocks, more savings, more property, more cash. But the bigger your wealth becomes, the more the financial system itself changes around you. At $500, you're trying to build a foundation. At $50,000, you're building assets. At $500,000, you're building financial leverage. At $5 million, you're structuring wealth. And at $25 million, you're thinking about what happens to that wealth after you're gone. The biggest change isn't the number in your bank account, it's the number of financial options available to you. And that's the strange thing about money. The first few $1,000s can feel almost impossible to build. But once you have capital starts giving you options. And those options compound, just like your investments do. If you want to understand how the financial world changes as you move up the ladder, subscribe to The Long Game. Because we're not investing for tomorrow, we're playing the long game.